Are you looking to invest in 2023? For your information, the markets this year are probably going to be just as unstable as the ones we experienced last year, which means you should wisely invest. But how? You might follow the very principles and philosophy of Peter Lynch. The strategies of this true legend in the world of investments can earn you financial success this year. Here's how. Even the most novice investor should recognize the name Peter Lynch. You ask why? Because he has a storied 13-year track record of overseeing and dramatically increasing the assets of Magellan Fund, which is why he is such a renowned fund manager. Peter Lynch is the most well-known sage of the present-day financial world. You won't believe that during 1977 to 1990, he increased a $14 million fund to an astounding $18 billion. This really made him highly respected and followed by investors all around the globe alongside Warren Buffett. Lynch formed his investment philosophy while working at Fidelity Management and Research, where he also managed Fidelity's Magellan Fund, which helped him achieve substantial prominence. During Lynch's tenure, which started in 1977 with the fund's establishment and lasted in 1990 with his retirement, the fund consistently ranked among the top stock funds. Between 1977 and 1990, when Lynch served as manager, the fund continuously returned an average of 29.2% per year, making it the best performing mutual fund in the world. The S&P 500 earned less than half as much at that time as this. The assets under administration expanded over his 13-year tenure from $18 million to a staggering $14 billion. Lynch is convinced that utilizing his approach, private investors have a clear advantage over Wall Street and big money managers. His investing strategy has not only passed the real-world performance test, but it has also passed with flying colors. Lynch made his first profitable investment in the Flying Tiger, an air freight company, and his approach to investing has been praised for being adaptable to the economic climate at the time. He used this to pay for graduate school. He has managed money for years and feels that the majority of businesses fall into the following categories.
You presumably were under the same pressures as other fund managers to show performance results.
Right.
Did that incline you to sell too quickly sometimes?
Well, I think my greatest mistakes are, it's funny in a stock, all you can lose is 100%. I've done that. But your great mistakes is selling a good company, and then it doubles, then it triples, and it quadruples, because you make a lot of mistakes, and so those ones that go up tenfold, I call them the 10 baggers. So some of my mistakes are just saying, oh my God, this stock is too high, and I was wrong. And you had to figure out, what inning am I in this baseball game? I sold Toys R Us way too early. It went up 20-fold after I sold. I did the same thing at Home Depot. Those are probably my two greatest mistakes I ever made.
When should you sell?
Well, you ought to find out why you bought a stock. If you're saying if it's a cyclical company and they're doing poorly, and they're doing awful, you wait till things are getting better, and they're doing terrific, and then you sell it. But with a growth company, you have to say, Walmart's case, 10 years after they went public, you could have bought the stock and made 500 times your money. Because they still are only in 15% of the United States. And they could say, why can't they go to 17? Why can't they go to 19? Why can't they go to 23? So for the next 4 decades, they went around the country. So you have to say to yourself, in this stock, I have a 10-year story, a 20-year story. You ought to be able to write that down and follow that. That's what I do with the company. And that's your decision. That's how you sell it.
We have a novel element for many investors today in the trust issue.
Yes.
We also have security problems that we didn't traditionally have in America. Have they changed the way you pick and believe in stocks?
No, you still buy a company, and you buy a company to grow. And if it's a textile company or it's an electronics company or software company, you better understand what they do. And if they do well, the stock will do well, no matter what happens to the market. If the Dow Jones today was 1,000 or 500, you would have made a lot of money in McDonald's. You would have made a lot of money in Johnson & Johnson. You would have made a lot of money in Gillette. These companies' earnings have gone up a lot the last 30 years. And if the market was 50,000, you would have lost money in Burlington Industries. I recommended that in 1969. I think it's gone from 34 to 2 with no stock splits because their earnings have been terrible.
Well, your modesty actually makes an important point, which is people with the best batting averages in the world don't bat 1,000. Yeah. I sometimes get angry mail, particularly during bear markets, saying so-and-so recommended such and such and it went down. Yeah. Well, how often did you come up with a clinker?
Well, this is a funny business. You don't have to be right even 5 times out of 10. If the times you're right, you make a double and triple. It offsets all those times you lose 20 or 30%. So when you buy a stock, you got to say to yourself, how much can I lose and how much can I make?